Welcome to the InterMarket Analysis video update. This video attempts to look at other markets outside of the S&P 500 to get some clues as to what's happening inside the S&P. We not only look at other stock indexes, but we also go through some other markets, the bond market, commodities market, and look at ratios to see how is the S&P performing against other markets. Can we get any insight from that analysis? And then is there anything actionable that we can look at to help us make the best decisions possible? This is being prepared for Monday, February 27th. The first thing we look at is S&P 500 valuation. We want to know, is the stock market considered to be expensive, just about right, or inexpensive? This first chart looks backwards at the trailing 12 months to see where does the S&P stand based on the earnings that have already happened. When we're at a PE ratio of 20 or above, the market is considered to be expensive. When we have a PE ratio of 15, that means the market is fairly priced. And when we see a PE ratio of 10 or below, the market is considered to be inexpensive. Right now, based on this chart, the S&P is above the PE ratio of 20. That means that we're expensive on a trailing 12-month basis. Now, the market doesn't just look backwards. It really looks forward. And in a moment, I'll show you a forward-looking PE chart. Down at the bottom on this chart, we have the spread between the current price of the S&P 500 and the PE ratio of 20. Whenever we're above this blue line, that means that we are expensive. As the market had a lot of trouble in 2022, we briefly dropped below this line, but currently are above the zero line. This chart is put out by Edward Yardeni, and it looks at forward PE ratios for the S&P 500. So looking back, we are expensive, but looking forward, we have a current value of 17.5. If we get up to 20, then the market would be considered to be expensive. Now, one thing that's happened in 2022 going into 2023 is the earnings per share has been coming down. Price has been going up, and that produces an expensive market. For things to come back in line, we would need to see earnings go up, which is not what they're doing right now, or the price of the S&P to come down. And that's the tug-of-war that goes on every day in the markets. Another area that we look at is growth versus value. When the market's really going higher, that's because growth stocks are really going up. When the market runs into some trouble, that means value has come in, and value may not be going up, but it's going down less than growth. Companies like Microsoft, Google, Apple, they are growth companies, and you want to buy low and sell high. Well, when the market hits some difficult times, a lot of folks get into value investments, and they might be going down, but they're not going down as much as growth. The first area to look at is just a growth index, and we can see with the red line on top of the blue line that growth has been in an overall downtrend. Then we look at the pure value index, showing how value has been outperforming growth. Now we look at some ratios. This is the growth to value ratio, showing how growth is underperformed. Then on the bottom, it shows how value has outperformed. Another way we look at this is comparing different indexes. This just shows that growth continues to underperform value. Then we have an inverse of that same chart showing how value has outperformed growth. Another way to look at this is through some ETFs, showing again how growth has underperformed and how value has outperformed recently. Then the last chart just again looks at indexes for growth versus value, showing how growth has been underperforming. The reason I look at a lot of different charts is sometimes we get some insights by looking at indexes, ETFs, and so forth, just to give us some insight as to what is happening. Some other markets we look at are the 30 biggest software companies. We're getting really close to a golden cross here, but it hasn't crossed over yet. That could be positive for the growth stocks. Another area we look at is inflation versus deflation. This bottom ratio on the monthly chart just shows how inflation has been going down in relation to deflation, which kind of contradicts what we're seeing in the market with the CPI and the PCE. Those are inflation measurement tools that we use, and they have been going up but have since started to retreat. This is just another look at the inflation-deflation scenario. Another area to look at for inflation is a thing called the Baltic Dry Index. How much does it cost to ship products from one point to another? When this is going up, that means the cost is going up. When this is going down, that means the cost is going down. And based on this chart, we're not seeing an awful lot of inflation. Commodities are another thing that we look at for inflation. And in 2021 and into 2022, commodities did really well. Since then, they've fallen back as they assume a downtrend. Then we look at a number of different commodity prices, such as corn, which after spiking up has been coming back down. Aluminum is also getting close to a golden cross here, but it's been really choppy as of late. Heating oil, after spiking up, has been coming back down. Gas, after spiking up, has also been coming back down. Natural gas, after spiking up at 10, has now fallen below 3, and we're currently at 2.55. Oil has been maintaining a level between 80 and 75. Currently, we're at 76.32. Another thing to watch is diesel prices. After really spiking up, they continue to go back down. Wheat, which is what we use to make a lot of products, after spiking up, has also been coming back down. Fertilizer, which farmers need in order to produce products, after really spiking up, it also has been coming down. You can almost make a suggestion that this is a head and shoulders top, with a shoulder, a head, and another shoulder. Lumber, which is naturally what we use to build things, after having a real solid decline throughout 2022, started to bounce back up, but has since resumed its decline. The dollar, after having a real strong 2022, got to the point where it was declining to give us a death cross, but since that time, after hitting about 101, has been bouncing back. Looking at the euro against the dollar, where the euro had been going up against the dollar, lately we've been seeing the dollar rebounding slightly. We also look at the Japanese yen, which has been in an overall downtrend, but it did see some strength against the dollar, but lately it's showing some weakness. The middle chart is the euro, and then the bottom chart is the dollar. Looking at the British pound, after giving us a recent golden cross, has since been falling back. The Japanese yen, also a recent golden cross, but has been declining. Copper, another measurement tool used for the economy. When copper is going up, that generally means a better economic climate going forward. When it's going down, just the opposite is true. After giving us a golden cross and spiking up, copper has been coming back down. We also look at the copper to gold ratio, where copper is still outperforming gold, but showing some recent weakness. This is that same chart, but longer term. The black line is the copper to gold ratio, where it's been going up but falling back, and then we have the 2-year yield in green. Generally, these don't get too far apart from each other, and they have a tendency to go in the same direction. That's not what we're seeing right now. There's a pretty wide spread between these two, even though they're on different scales, and because of the wide spread, they're going in opposite directions. Gold, after giving us a recent golden cross, seems like just when that happened, we saw some weakness starting to come into gold. And the same thing is true with silver, a recent golden cross and then some weakness, and we've actually dropped below the 200-day moving average with silver. Looking at some indexes, this is the CRB, one of our inflation tools, against the S&P 500. It had really been outperforming for a lot of 2022, but lately has been underperforming, even though we're seeing a recent bounce. This is an inverse of that same chart where the S&P had really been outperforming, but then started to underperform the CRB index. It's getting back to the point in early 2023 where we saw a golden cross, but we're seeing some recent weakness. Looking at the NASDAQ 100, which are almost all growth stocks, versus the S&P 500, which is growth and value, this shows that the NASDAQ 100 continues to underperform the S&P 500, even though it saw some real strength after the start of the year, has since been chopping right around its 200-day moving average. Looking at the S&P 500 against some other stocks, these are mega cap growth stocks. These are the Apple, the Microsoft, the Google, the Amazon type stocks. They continue to be in an overall downtrend. Even though we've seen some improvement, we don't see a golden cross yet. This is that same index of mega cap growth versus an equal weight version of the S&P 500, where all of the stocks count the same, unlike the S&P 500, which is a weighted index, so the bigger companies have more of an influence. The mega cap continues to underperform the equal weight S&P 500. The S&P 100 continues to underperform the S&P 500. The S&P 100 are the biggest companies in the S&P 500. Small caps, which in a good, healthy environment, we'll see them outperform the S&P 500, and that's what they're doing right now. We're in an overall uptrend, and they've been holding up rather well, so that's more positive. Low volatility stocks, these are ones that folks get into when we're having trouble in the market, and they tend to hold up better during difficult times. After giving us a recent golden cross, has pretty much been chopping sideways. Then we look at a ratio of low volatility stocks against the S&P, where the low volatility stocks are still in an overall uptrend, but since the beginning of 2023 have been showing some weakness, but have as of late been bouncing back. This index looks at the Dow, the transports, and the utilities and puts them together as one composite average, still in an overall uptrend, even though it's shown some recent weakness. This is Dow theory, where you look at divergences and convergences between the Dow, the transports, and then I also include utilities. We're seeing where utilities are starting to go lower, where the transports are holding up a little bit better, where the Dow has pretty much been going sideways. And we look at this just to see what's really happening in the overall market. I don't use any studies on this chart. I just kind of eyeball what's happening. Another way to use Dow theory is to take the S&P 500 on the top and then compare it to the NASDAQ on the bottom. Some folks think this is a better representation of what's really happening. After breaking out with the S&P 500, we're starting to come back down. Well, we saw that same breakout with the NASDAQ, but it is also starting to show some weakness. So this is just suggesting that things are more negative. FANG stocks, the Facebook, Apple, Amazon, Netflix, Google, and a bunch of other stocks, it just gave us a recent golden cross, even though it is displaying some weakness. ARK, which has run into a lot of trouble after hitting its all-time high, it has bounced back up. It came down to just under 30, bounced back up to 45, but now is seeing some weakness and is still in an overall downtrend. High beta stocks. These are stocks that tend to outperform the stock market, either to the upside when you're right or to the downside when you're wrong. We saw a real breakout in high beta stocks in early 2023, but lately we're seeing some weakness. This looks at the S&P 500 and measures it against foreign stocks in Europe, Australia, Asia, and the Far East. The fact that we're above this red line shows that the S&P is outperforming international stocks. Then we look at the bottom. This is a PPO, which is an oscillator, but it's below zero and continuing to decline. What would be much more positive is if this could bottom and then turn back up. That could give some good support to the S&P 500, but we're not seeing that yet. Looking at bonds, this is a total ETF where we're in a recent golden cross, but we're seeing some weakness in bond prices. This looks at world bonds, also a recent golden cross, but now some weakness. Looking at the stock to bond ratio, stocks continue to outperform bonds on this monthly chart. On a shorter term basis, with the 7 to 10 year maturities, bonds continue to underperform stocks. Looking at high yield corporate bonds, after giving us a recent golden cross, has now been backing down. And the same thing is true with the investment grade corporate bond ETF, recent golden cross, but some retracement in price. Stock to bond correlation, they're having a pretty strong tendency to go in the same direction. When we're above 0.25 all the way up to 1, that means they're going in the same direction. When we drop to minus all the way down to -1, that means they're going in opposite directions. So if you follow the price of bonds right now, stocks are probably doing close to the same thing. We also look at corporate bonds. This is an index where we saw a recent golden cross, but bonds have been starting to decline. 10-year Treasury yield, after really spiking up, came back down. Now it's starting to head back up again. Here's another chart showing that we're currently at 3.949% for the yield. This is another chart showing the 10-year yield where we came all the way down to the 200-day moving average, and we've been bouncing up off of that as interest rates go back up. The 30-year yield is at 3.93. Another area we look at is the S&P 500 to the rise in interest rates, and this shows that the S&P has gone up less than the rise in interest rates. Looking at junk bonds, which are what people get into sometimes to get a higher yield when government bonds are not really giving them any return, but they are riskier, and these tend to follow more what the stock market is doing. We saw a recent golden cross, but junk bonds have been pulling back. We also look at the junk bond ETF against the bond ETF. Junk bonds, which are high yield bonds, against government bonds, and it shows how junk bonds have been outperforming. This is why a lot of folks get into junk bonds, even though they're riskier, because of the increased yield. This looks at the price of the 7 to 10 year Treasury bond where price has been coming down. And that's the inverse of the yield going up. We also have a number of our yield curves that are inverted. The 10 to the 2, the 10 to the 3 month, the 30 to the 5 year, the 10 to the 5 year. I don't really look at this bottom chart too much because the Fed funds rate doesn't update all that often. As we drop below zero, that means all of these yield curves are inverted, and that tends to foresee that we will head into some kind of recession going forward. The most important ones are probably the 10 to the 2 and the 10 to the 3 month, the top two charts. This is a daily chart showing how yields had been coming down, and that gave some good support to stocks. Well, now we're starting to go back up. This is a weekly chart of international yields where the US, UK, and Germany are all going higher again. Japan's its own little story right now, but we're keeping an eye on that. We also look at the ratio between the S&P 500 and utilities. When this is going up, that gives good support to the S&P. When this is going down, that means the S&P is usually going down. After going up nicely in the early part of 2023, we're now starting to come back down, and that could be giving some headwinds to the S&P. The staples sector, these are the things that you have to have no matter what's going on in the economy. After giving us a recent golden cross, are falling back, and we're dancing along the 200-day moving average. Looking at energy, which has been in a solid uptrend against the S&P 500, saw some weakness, but we might be finding some support at the 200-day moving average. The tech sector also just gave us a recent golden cross, but we're also seeing weakness as of late. Semiconductors, recent golden cross, but starting to fall back. The tech sector against the S&P shows how the tech sector had really underperformed in 2022. It was starting to break out, and it's still looking okay, but we haven't seen a golden cross yet. Looking at the S&P 500 against discretionary, these are the things that make life fun. This shows how the S&P had actually outperformed discretionary. Discretionary got hit hard in 2022. Then on the bottom, we have an inverse of that same ratio. We're looking a lot better, but we're seeing some recent underperformance in discretionary. Energy still continues to be in an uptrend when compared to the S&P. Materials also in an overall uptrend. The financials also in an uptrend with the blue line on top and the red line below. Real estate is still in an overall downtrend as we've been seeing some recent weakness in that sector. Utilities, after giving us a golden cross, fell back, and now we're seeing a death cross, but we're seeing utilities recover slightly going back the last few weeks. Healthcare, another area that you have to have healthcare no matter what's going on economically. This is still in an overall uptrend, but healthcare has been starting to show some weakness. This is another ratio showing how healthcare is still in an overall uptrend, but fell back. Will we see a death cross in the near future? This looks at communication. These are the internet companies. They're still in an overall downtrend. And staples, still in an overall uptrend. The industrials, the things that you use to make things, still in an overall uptrend. The NASDAQ to the S&P 500 is still in an overall downtrend. It was bouncing back but showing some weakness. The NASDAQ 100 against the NASDAQ. NASDAQ 100 still is outperforming the NASDAQ. Some other areas to look at, growth, which are the stocks that people like to buy low and sell high, compared to bonds. Both got really hit hard in 2022. Growth is just starting to outperform bonds with a recent golden cross, but we're seeing weakness as of late. The rise in yields against the tech sector shows that yields have been going up a lot faster than the tech sector has been doing. And this is an inverse of that same chart where tech is underperforming the rise in interest rates. Discretionary against staples show how discretionary has been underperforming the staples. And staples have been outperforming discretionary. Energy has been outperforming tech, where it wasn't that way before 2021 going into 2022. Gold is trying to outperform the S&P 500. It's still in an uptrend, but showing some weakness in the ratio. And then gold to the dollar. As the dollar was going up, the gold to US dollar ratio was going down. Then as the dollar was showing some weakness, this ratio is going back up. Now, as the dollar is rebounding, we're seeing this ratio going back down. High leverage loans, these are pretty risky loans, and as I say in every video, if we thought the economy was going to fall off a cliff very soon, you wouldn't see this with a recent golden cross and showing some significant gains. Looking at the 3 to 5 year government bonds against investment grade bonds, typically we look at this chart the same way that we would the VIX. When it's going up, that means there's more fear, and that's a red line. When it's a blue line and going down, that means there's less fear. Well, at the beginning of 2023, we saw fear really starting to decrease, and it's been coming back. Now we're waiting to see, are we going to continue up with the fear, or will fear start to subside? This is an intermarket analysis chart showing how oil and the dollar have been positive since the beginning of 2022, where gold has now slipped over negative, stocks and bonds continue to be negative. Looking at some indexes, this is the Amex, the Nasdaq, and the NYSE. We take a 5-period moving average of the highs minus the lows. When we're above zero and advancing, that's positive. When we're below zero and declining, that's negative. Well, we're dropping below zero. Here's the small cap index. After coming up to this R1 level, has since been going back down, even though we have a recent golden cross. This is another look at a small cap index with the Russell 2000. Recent golden cross went all the way up to what had become resistance, back down, hit support, bounced off of that, but now we've recently broken down through support. On the top, we have the RSI below 50 and declining, and we have a declining MACD. This looks at the small caps versus the S&P 500 ratio. That's the red chart here. When this is really going up, that gives good support to the S&P. We're not really seeing a breakout right now. And then the blue line is the S&P 500. The mid caps, after hitting resistance, have been falling back, even though we have a recent golden cross. The Dow has been pretty much chopping sideways, but since that time has been falling back down below this pivot level. We're still above the 200-day moving average. If we continue to fall, we'll be watching that level. This is the Elder Impulse system against the diamonds, and we're still in a downtrend. The NASDAQ continues to be in a downtrend. Even though it had been bouncing up, it hit this resistance level and has been falling back. This also tries to measure the Fibonacci retracement from the all-time high going to the October low. We never did hit this 38.2% retracement after falling back. The NASDAQ 100 is right down at its 200-day moving average, so that's another thing we'll be keeping an eye on. The Qs for the NASDAQ 100 using the Elder Impulse system are still negative. And this is a retracement of the NASDAQ 100 from the all-time high to the October low. We came right up to this 38.2% retracement and have been falling back. The NYSE composite just gave us a recent golden cross, but we're also seeing some recent weakness. The Wilshire, recent golden cross, recent weakness. All stocks, recent golden cross, recent weakness. Emerging markets, recent golden cross, recent weakness. How's that for a broken record? Internationally, China, emerging markets, Europe, Japan are all in downtrends, and we're just starting to roll over with our S&P. Bitcoin, after getting back up into the 24s or so, has since fallen back. Looking at some correlations, the S&P to the dollar, they're having a real strong tendency to go in opposite directions, where S&P and oil are going in the same direction. S&P to the 10-year yield, opposite directions, and the tech sector to the 10-year yield, opposite directions. S&P to the 2-year yield, fairly strong relationship going in opposite directions. And the home builders, after really coming up with the S&P, we've been backing down. Well, the home builders have been doing the same thing, and so our ratio has still been holding up fairly well, and they're having a pretty strong tendency to go in the same direction. What we're looking for on this chart are divergences or convergences. Right now, they're converging. They're going in the same direction. If the home builders start to fall apart and the S&P is still going up, that would be a big warning sign for us. Looking at some long-term charts, this is a monthly chart of the NYSE on the top, and the Copic curve on the bottom. It's trying to roll back over, but this is a very long-term chart, and it takes a long time for these indicators to change. Here's the NYSE composite with the NYSE record high percent index. It is starting to bounce back up, so that's giving some support to stocks. And the S&P 500 against the PPO is also showing a recent crossover positive. We also look at the ratio between the S&P 500 and the CRB index. It's trying to turn back up, but hasn't quite crossed yet. And S&P 500 against global stocks still in an overall decline with the KST, but we're above this red line and trying to turn back up with the ratio on top. Here's the S&P on top with the CRB to bond ratio, where the CRB is starting to underperform bonds. That could give some good support to stocks. And looking at the 30-year price, and then a ratio of that against the CRB index, where it's showing the bonds are trying to turn back up in relation to the CRB index. And here's the CRB, which had been doing quite well against bonds. This is more or less an inverse of that same chart we just showed, where the CRB is starting to underperform. And then here's bond price on top with the ratio between bonds and the CRB down below, also showing that bonds could be turning back up, but we're seeing a lot of recent weakness in our daily and weekly charts. Here's another ratio on a weekly chart of the bonds to the CRB, where in the short term the KST is still negative, but in the intermediate term the KST is still positive. Looking at some of our scenarios, none of them are really on the table now. This is really just an update of these charts. We look at a ratio between the Qs and the S&P. We're still in an overall uptrend, but showing some recent weakness, and that's going to be the name of the game on these charts. We're discretionary against the S&P, also is pulling back, and large cap growth is pulling back against large cap value. This just measures growth versus value with the large caps pulling back, mid caps pulling back, and starting to underperform with the small caps. This looks inside the S&P 500 to say what stocks are above their 50-period moving average. We're continuing to decline as we're seeing some weakness in the S&P. This looks at the mid caps, also showing some weakness, and the small caps continue to show some weakness. So what's positive? Well, those things that are positive could be the value indexes as well as ETFs. The euro, the Japanese yen, and the British pound remain positive. Copper, gold, and silver. Low volatility stocks, the composite average, bonds, looking at ETFs, high yield, investment grade, world bonds, as well as corporate bonds. Even though they're showing some recent weakness, they're still in overall uptrends. Junk bonds, staples, semiconductors, high leverage loans, small caps, mid caps, and the Dow, even though recent weakness has been coming in. The NYSE composite, as well as the Wilshire, all stocks, and then emerging markets continue to be positive, even though they're showing some weakness as of late. What is negative? We have growth, the big software companies, CRB index, the dollar, mega cap stocks, FANG and ARK, as well as the tech sector, the NASDAQ and NASDAQ 100, Bitcoin. Thank you. I hope you found this useful. Please feel free to check out any of the daily videos that I post as well as the weekly video. I'll also be preparing the deep dive video very soon, as well as a supplemental video, which is when I go through a lot of charts that I find at isabelnet.com. So I will talk to you in the next video.